Hello and welcome to Onward, the Fundrise podcast. We are continuing with the new format of Investor Q&A with Kendall, Head of Investor Relations and Investor Operations. My name is Ben Miller. I am CEO and co-founder of Fundrise. Before we get started, I just want to remind you that this podcast is not investment advice. It is intended for information and entertainment purposes only. Okay, let's get started here, Kendall. How are you doing?
I'm good. Happy New Year, Ben. Or almost Happy New Year. Any fun plans for the evening?
Yeah, I'm going to try to get to bed before New Year's.
That's my goal too. I'm actually solo with my 3 kids. So if it sounds like I've already been partying, that's why.
Wow.
So anyway, it has been quite a year and it's been amazing listening to the evolution of this podcast. It's been a lot of fun. But just to cut to the chase here, I think a lot of our investors are going to have questions about year-end performance that they're seeing in their portfolios. So we're going to do this a little bit differently this time around. And we're going to try to anticipate some of those investor questions. Are you ready for it?
Let's do it, Kendall.
All right. We're seeing NAVs down. So in particular, the flagship fund NAV is down. Walk me through a little bit more on why that is. We've been very fortunate that this is pretty unprecedented for us in our platform. What gives?
I'm going to give you the short answer, and then I'm going to give the extended answer. So the short answer is that income grew rapidly through 2022, but interest rates and cap rates expanded even faster than income, especially in Q4 of 2022. So let me get into it now in a fulsome way. So in 2022, and for that matter in 2021, net operating income of the Fundrise portfolios grew by huge amounts. For instance, the flagship fund in 2022, from January 1st to December 31st, had same-store growth in NOI of 16.5% in this residential. So that means that the same unit grew 16.5% in NOI. So that's huge.
And NOI being net operating income.
Right, net operating income. So it's way higher than industry average. And actually our build-to-rent portfolio, which is one of our top strategies these days, it grew by 24%. So we had huge NOI growth, property growth, yet NAV came down at the end of the year. So what's going on here? There's a lot of things driving NOI. Like 2021, 2022 also had a lot of inflation. We had great geographic rent growth. And we also had a lot of value add execution, like a lot of work being done by the team. And that's what's driving NOI. Virtually every key indicator, like rent growth, occupancy, all performing at or above expectations. So you have great real performance on the ground, but nevertheless, cap rates expanded even faster than NOI did, especially in Q4 as the private markets repriced. I'll note anyone who redeemed during Q4, though, gets the December 31st NAV in the flagship fund. But let me get into that because Fundrise really did outperform S&P 500 and Vanguard REIT Index. On average, they were down 25, almost 30%. So we outperformed by a lot, but there's a nuanced story because there's a lot of funds and a lot of investors. We have 383,000 investors. So across the whole platform, every asset, every investor, the average return was actually slightly up. I think up approximately 0.5% across everybody. But with some variations across the investor groups, the flagship fund was down about 5.5% for the year, while the more mature funds, the E-REITs, were largely up. The reason why there was a big performance difference is the mature funds are further along in their business plans. They've been around longer, so they've made a lot more progress in the value add that they've been harvesting and building towards. As they stabilize, they can get fixed rate debt. So the mature funds have typically 10-year fixed rate debt, and that essentially insulated them when interest rates skyrocketed. So they ended up performing stably because that debt a year or 2 or 3 years ago at 3.25% is looking pretty good these days.
Right.
The flagship funds are the other side of the value creation world where we're doing a lot of work on the ground, like building buildings and value add, so that as a result, it was more impacted by the change in the yield curve,
right,
change in interest rates. So that's the short of essentially why there's some variation across the investor base.
Yeah, that makes a lot of sense. And just to zoom out a little bit, there's the fundamentals you're talking about here, determining if an asset is performing, And a lot of the things like occupancy rates you're talking about are driving that. And then there's technical or paper assessment of the value of the asset. So that's where the macroeconomic factors come in. You're looking at the impact of rising interest rates.
Yeah. So I want to not leave out the income fund because we're talking about equity. And there are investors who are mostly income invested, focused on current yield. And so the quick and dirty on the income fund is that the flagship income fund was up 5.5% approximately for the year. And a typical public credit fund was down 10 to 15%. So that's a big delta. We really outperformed on the income fund. We can kick that question to later. Why did the income fund outperform most credit funds or mortgage REITs, et cetera? Across the board, sometimes the team can be a little frustrated because Fundrise really did outperform almost everybody in 2022, way ahead of Vanguard REIT Index, which was down 25% or so, and S&P 500 is down 20%. Flagship's down 5.5%. So it's way, way better. But still, like, people are unhappy. Some set of our investors are maybe disappointed. It kills us a little bit that we had a down fund. I think we had maybe 3 funds, the newer funds that were in this heavy value add. But anyway, I thought it'd be interesting to talk about the investment strategies we pursued into 2020, 2021, 2022, because if you look at what we did, I can summarize it. It really explains why we outperformed by such a big measure. Because you're talking about a typical fund outperforms their benchmark 1%, not like 15%, 20%. And so I think explaining that would help people understand how different we are than the typical public REITs or Vanguard or other things they may see out there in the public markets.
Let's go there. Do you want to start with 2020? Does it help to go back in time?
Yeah, so we are going to share some images. And one of those images is basically a picture of the economic cycle. There's periods of hot times and there's cold times in the economy, and there's a pattern to it. And so in 2020, 2021 especially, we really had that in mind. So let me just summarize the things we did differently, and then I'll actually want to get into even more detail about those things. So one, especially in 2021, we were heavily focused on value and cost basis, not yield. Meaning, two, we pursued new construction. We built rather than bought. New construction residential, new construction industrial in fast-growing markets. And then at the top of the cycle, there's things you generally should do. You should build, not buy. You should purchase super high quality, not low quality. For example, IG or investment grade versus junk bonds. That's the quality difference. 3, you should focus on alpha, not beta. Beta is basically volatility. Top of the market, volatility goes away. And when the market collapses, volatility spikes. And lastly, you want to position your portfolio defensively. So those are the things we did, basically why we outperformed. But we're not immune to the Fed raising rates from 0 to 5%. And essentially our NAVs have baked into their values that Fed funds are essentially going to be 5.1%. And that's what's hitting our valuations. I want to get even into more detail if you're with me on this, Kendall.
Yeah, let's do it. And just to put some numbers behind that, I think around 60% of our interval fund is allocated to single family rental. And most of that is an example of what you're talking about with the build versus buy. And then we're seeing that again on the income portfolio side with our income fund.
Yeah. So let me get into more detail. So I have a couple of things. Let's go actually in reverse order. Let's talk about how we defensively position the portfolio. We can never be certain when is the top of the economic cycle. Like late 2021 felt like a pretty good bet. And as a result, we started managing the funds extremely defensively. And the 2 main ways we did that was by lowering the amount of leverage, less debt, and 2, by building up extra liquidity. Now, here's some key metrics. Average leverage on the Fundrise platform versus standard amount of leverage in the private markets. So standard in private markets might be somewhere between 65 and 75%. Average leverage, a Fundrise platform, 40, 41%, way lower leverage. Total cash or liquidity available on the platform, typical portfolio might have 2 to 5% cash, especially an investment portfolio. Fundrise, nearly 600 million, 18.5% approximately. That's a very defensive portfolio. And that's one of the reasons why the interest rates that skyrocketed had a muted effect on the portfolio That and the fact that a lot of it was fixed rate debt. And the portfolio is designed essentially for what we thought was going to be a stormy period. So we were much more focused on risk than return in late 2021 and early 2022. And to tease probably the question eventually you'll ask, which is like looking forward, it allows us to move from defense to offense because we probably have very few problems in this part of the cycle. So we can move to offense and start to deploy that cash and take on more leverage at the bottom of the cycle rather than at the top. So that's one big reason why we did pretty well. Not perfect.
Yeah, no, I think that makes a lot of sense, Ben. Having that amount of cash on hand, what sort of impact do you believe that had on our performance this past year?
Yeah, that's a super good point. We got this question early on in 2022. Q1, our income fund had a really low yield. People said, why isn't the yield higher? Because we're holding all this cash. Now, in retrospect, that looks smart, but at the time, it's like delayed gratification. You had to take your pain early so you didn't have 10 times the pain later. So that's a good point about how cash can seem like a cash drag in good times. And in bad times, it's like Warren Buffett. He uses it to make great things happen at the bottom of the cycle. There are other things that are really interesting about this cycle. And I have this image I'm going to keep referring back to. This one, Kendall. It's the one that talks about the investment strategies during the economic cycle. But at the top of the last cycle, what we did was we bought high quality and value and cost basis, not yield. We shared this visual, and it's funny, I called it an economic cycle because there's a pattern. Definition of the word cycle is, quote, a series of events that are regularly repeated in the same order. So it's called an economic cycle. And so now you can say, okay, if it regularly repeats, then I can have a sense of what might come next and what you might want to do ahead of time. So like, what are the attributes at the top of the cycle? The two most important are interest rates are typically low. Like in 2021, they were basically zero. And that means that yields become overvalued because when you're discounting income by close to zero, that usually increases the price. You want to avoid buying yield. And that's what we did in 2021 and 2022. Instead of buying yield, we focused on new construction, building communities of homes for rent, building industrial. Our current NAV for all this new construction, single-family rental communities is approximately $190 a square foot. So what's really interesting about that is they're close to replacement cost. In some places, maybe below replacement cost. I mean, it depends on the market. There's a lot of ways to look at the right NAV, but one way to look at it is the cost, the basis. I feel really good about that price per square foot. Second attribute, key attribute of a top of the cycle is over-exuberance and optimism. Because what happens when people are over-exuberant is a risk gets underappreciated and growth gets overestimated. And we all saw that happen in 2021. And what you do in that situation, you want to invest in high quality value investments. At the top of the cycle, value is where you want to be, not growth. So that's what we did. We bought new construction, which basically higher value old construction, right? The Invitation Homes or American Homes for Rent's homes are probably about 20 years old, and our homes are about 1 year old. So there's a big difference there.
If you're at the top of the cycle, how do you think about the fact that you're at the top of the cycle? You're still buying at the top of the cycle.
No, because you're building, you're not buying. That's the key.
Yeah, I think some of the questions that we see from our investors is you're deploying capital, though, at the end of the day. You're still buying land or there's some asset that you're acquiring and you're acquiring it out at the top of the cycle. So how do you reconcile that?
You do sometimes see really bad downturn that things sell for below replacement cost. You saw that in 2009 and 10. I don't think you're going to see that in 2023. It's possible. I don't think that's likely. I don't think we're going to see that on home building, on the kind of assets we own. We're in market right now, and we're not seeing that at all.
And why is that?
One is that input costs, construction costs, they're not coming down. I mean, we have projects where you still can't get electrical panels. There's a labor shortage. It's still fairly tight, and I don't think that construction costs have moved materially so far. And I don't think they're going to move materially. Maybe on the labor side, margins will compress. The second reason the build for rent strategy is so interesting as a real estate strategy, because when you have these communities that we build and buy with the home builders, there's really two ways you can exit. You can exit as a stabilized multifamily, or you turn around and unwind it and sell as single family homes for home buyers. And we've seen both of those buyers actually fairly resilient. There's a bottom to the market in both cases. And that's for one case driven by yield, another case driven by purchase price. There's just enough drivers in the economy that have actually kept newly constructed homes from falling too much. I mean, they have fallen, and I'll get into that in a minute. And that's part of our NAV process is home prices have fallen maybe 3 to 5% nationally, depending on the market, a few places more, a few places less. And we're expecting them to fall another 3 to 4%. Maybe they're down 7% next year, 8%, something like that. That's in our forecast. That's why I feel pretty good about the marks. But you don't know. Obviously, we don't know. The X factor in this cycle that typically isn't in a standard economic cycle was inflation. There's normally inflation at the top of the cycle, like there was in '07, but not like the magnified inflation we had from the pandemic. And during inflation, you want to be in real assets, not financial assets. That's why bonds did so badly and real estate and commodities did so well, because they essentially picked up the inflation and bonds couldn't. Those are the fundamentals that we brought into our thinking in 2021, 2022, and essentially drove us in a lot of the outperformance in the portfolio.
Yeah, this all makes a lot of sense, Ben. I'd love to go back a little bit to when you were talking about the income fund outperforming peers. Why is that? Could you talk a little bit more about our strategy there and why you think that played out the way that it did this past year?
Yeah, it's such a good point. The income fund vastly outperformed almost every other credit fund out there because it pursued a very different investment strategy. Most funds, especially public funds, investment grade bond funds or high yield or mortgage REITs or any of these credit funds, lots of non-bank financial credit funds, they lever their funds. They use leverage. That's actually really standard. They buy different kinds of bonds in the market and then they lever them up. Our funds, we don't use fund leverage. We basically always been more comfortable with taking real estate risk, taking real economy risk, than taking interest rate risk. Financial economy is not where we come from. In some ways, we're the anti-financial economy asset. And so we could underwrite the real estate and feel really good about the credit, but we can never really underwrite interest rates, just outside our control. And so when interest rates skyrocketed, those levered funds just got wrecked. That's really the main difference. And you could talk about treasuries. Even treasuries lost a lot of value. And partly it's because you're buying treasuries close to zero, and our income assets were at 8, 9, 10, 11, 12. And so the marginal difference going from 0 to 5% Fed funds has a smaller impact on a 12% interest rate asset than it does on a treasury at 0.25. It's just very different, but it's so significant how different the private markets are from the public markets. And most investors essentially just can't get to them. So anyways, I think that's the performance difference. It's funny now, going forward, interest rate risk seems like a different kind of risk now. In some cases, more attractive than it was. When interest rates were close to zero, it was like, well, they can't go anywhere but up unless you could lock them. And it's hard to do that with credit funds. Okay, what's next, Kendall?
So, Ben, I have to ask, there is a perennial question that we get. How do you compare our funds to the Vanguard REIT Index? We've outperformed VNQ this year. Tell me more. I feel like this is something that our investors always want to hear about. So I'd love for us to tackle it.
So I'll give a brief answer in here because I'm not going to talk about in depth the difference between public markets and private markets. But we invest largely in private markets, so that's a big difference. Our performance this year, we're across the whole platform, more approximately flat. Our flagship funds down 5.5%. VNQ was down. Vanguard REIT Index was down approximately 26% or 25%, 28%, down a lot more. And I was looking at the 3-year and 5-year performance. Currently, 3-year performance, it's up over 3 years, 1.6%. So 1.6 in 3 years, and up over 5 years, 4.7%. So what's going on there? So I think there's a lot of things, difference between public and private markets, but what's happening inside this fund is that VNQ is made up of approximately 50% retail, office, and hotels.
Yikes.
Yeah. And so especially retail and office have just gone from bad to worse every year. It's going to be a rebirth for those sectors because retail and office have to be remade. And hotels got smashed by the pandemic. So there's just a lot of underperformance in their portfolio that has nothing to do with public versus private markets. It's just made up of a lot of assets that have been disrupted by technology. I actually got this question recently from somebody on Twitter. Somebody asked me, is the innovation fund like a distraction from your real estate? And I love our investors because they're all skeptics. I say like, skeptics are my people. And so I wish our investors could sit in the room with me as we work through technology and real estate in the same room. You go back to like 1995, real estate has been completely transformed by technology. Every year, the impact of technology on real estate has been more than the previous year. And the real estate people basically are not technology people, and they really don't think about technology. And they actually might ask me, like, isn't this a distraction? I'm like, no, technology is basically becoming more and more essential. And there's so many things about it that are crossover learnings. We're just going to be a better real estate investor, and we're going to build better real estate technology for our investment platform as a result of this cross-pollination. It'll become clearer over the next couple of years as we produce more content and sort of show, don't tell. Anyways, I think it's the biggest mistake of the real estate industry this century. They underestimated technology and they don't really have it as a core competency. And it needs to be a core competency of every industry.
Yeah, I think you hit the nail on the head. And when we stop getting the V&Q question, I think we've arrived.
Index investing beats in public markets because they're efficient, and private markets are not efficient.
It's a good point.
That's why there's alpha available in private markets. Let's do next question.
So we've talked a lot about the past. I'd love to now look forward and think through, what does next year look like? What are you expecting? And how are we positioning the portfolio based on those expectations?
Yes, what's next? That's a great question. Difficult to know for sure. Again, there's a pattern to cycles, and the saying is history doesn't repeat, but it rhymes. So what's happening in the market? The other major image I want to focus on was essentially this inverted yield curve. So the yield curve is the barometer of the economy, and the barometer has been falling. Like when the barometer falls in weather, it means there's a storm coming. The yield curve's inversion has been a red flashing light that there's a recession coming, like a stormy environment of some kind is on its way. Some companies might not be able to withstand stormy weather. They didn't build an ark, because the problem with an ark is it's really slow and expensive to build an ark. And when times are hot, you get rewarded for going fast, taking risks that maybe your boat doesn't need to weather a storm. We're the tortoise, so we focused on building it right. Think long term. Don't use too much leverage, right? Those are key ways to build a better arc. So the yield curve, throwing that term around, just what is it? It's the future price, basically, of bonds shown by their income, by their yield. And you can look out 10 years or 30 years. In a healthy economy, the yield curve is sloped upwards. If you wanted a 30-year fixed mortgage, you'd pay a higher interest rate. That's logical, right? If you're going to borrow for longer, it's going to be more expensive than if you're borrowing for shorter. But in an unhealthy economy, one that's likely to go into recession, what happens is that borrowing for 1 year, like a 1-year mortgage, is actually more expensive than a 30-year mortgage. That's like almost insane to think about. Wait a second, I'm going to borrow for 1 year and it's going to be more expensive than 30 years? Something's broken. So that's why it's a really good signal. And today, the 30-year treasury is about 3.75%. And the overnight treasury, not even 1 year, like overnight borrowing, if you were going to borrow for 1 day, it's 4.5%. So 4.5 versus 3.75. So that's, they call it highly inverted. And it hasn't been that inverted in 40 years, since basically 1981. And that's telling you there's going to be a recession. I love the yield curve. That's why we included it in the year-end letter, because it's got lights on the runway or something. You're in the dark of the night, it's like telling you where to land. It's like a roadmap. And we actually took the image of the yield curve so you could see, here's where we are now. And it's basically near the bottom. There's a lot of indicators actually that were close to the bottom, which has really been transformational in the market over the last 30 days or so. The credit markets probably bottomed, and they bottomed in October. The Bank of America High Yield Index peaked at 9.5% yield on September 30th, 2022, and has been falling since then. Today, treasuries are around 3.75%, and they were 4.4% in October. Today, high yield's around 8.5%. So it's down from 9.5 to 8.5. Treasuries are down from 4.4 to 3.75. There's probably going to be volatility in that, but like the trend is pretty clear at this point, in my opinion. And that's because we've passed peak inflation. That's the big uncertainty that everybody's been watching and wondering and to some extent freaking out about was like, what would it take to get inflation down? And there's no question inflation's coming down as measured by CPI and PPI and PCE, et cetera, but how much it has to decline. But it's declining month on month. In June of this year, 2022, it was 1.3% month on month increase in inflation. And in November, CPI was 0.1%. We can debate if it's going to come down to 2% or 3%, but it's definitely coming down a lot. And that basically is creating a ton of clarity in the markets. And so it's actually making it easier to price assets, a lot easier. Don't get me wrong, like it's not smooth sailing from here. Real economy actually lags the financial economy. But we can see at this point the other side of this downturn. It's actually in the forward curve. Basically, it's saying it's 12 months, maybe it's 18 months. No longer as much uncertainty as there was. Once you have uncertainty reduced, most market participants, once they act and they lend and they buy, you can restart the virtuous cycle. And that's what I think we're seeing. Forward curve giving you the shape of the downturn. And we're much closer to the bottom than we are to the top. That's without question. The things that you wanted to buy before, like high quality credit and high quality assets, this image we shared about the investment strategy to pursue during the economic cycle, we're in the transition period where you want to be looking at opportunistic investments, credit, and you want to buy high quality because they're about to appreciate. In the bond world, high quality is like IG, is investment grade. In real estate, it's Class A infill type stuff. So I'm not saying you want the real estate yet, but I think it's starting to become interesting and you want to be opportunistic. The real point, super helpful to see the pattern distilled, to have a little bit of a compass, like a guide to say, here's where we were, here's where we are. We're in this transition period. We're getting close to the bottom. Some parts of the market may have already bottomed. It just helps you know what to do. And we struck NAV based on all this data or all this thinking I'm sharing with you. The team spends hundreds of hours building up NAV from the bottom up, and they get appraisals and they have auditors and they have all this process. At a high level, you can see what's happening. So it could get worse. Like we could have another black swan like we did with the war in Ukraine. But in my view, the probability is likely more things break to the positive going forward. There might be armistice in Ukraine. There are things that I think that are more likely to break to the positive than break to the negative at this point. And that I think should give people a fair amount of confidence into what the next 12 months look like. It's like more opportunities if you have liquidity than probably any time since 2008 or 9, like in half a generation.
What are you seeing in the market? Are you beginning to see activity? Because to your point, when there's uncertainty, people tend to sit on the sidelines. Are you seeing others come off the sidelines yet? And how do you think about that in terms of what that might mean for our strategy and performance next year?
So the image we show this, but basically today you want to be in credit, largely credit. That's where the action is today. Credit's pretty much bottomed. And there's going to be a huge amount of demand for credit, for borrowing. And we're heavily focused on providing that nicely priced rescue funding. There's going to be billions and billions of dollars of need for it because most private market borrowers were at 65, 75% leverage when they borrowed at 3%. And now they're going to be borrowing at 6% or 5.5%. That means that basically they probably have too much debt and they have to pay it down. There's going to be a lot of demand for capital to pay down that debt and come in as mezzanine or preferred equity. So that's going to be, I think, a huge part of our strategy in the first part of the year. We're going to hang around the hoop on opportunistic buying, and we're definitely watching closely, and we'll likely do a little of it, but the action's not going to be probably till the spring when the home builders see how the spring season goes for the consumer. And then the innovation fund, which is our tech fund, that I think is going to basically have like a breakout moment because the tech market has basically collapsed. And what happens when a financial sector collapses is that there's an opportunity or opening for new entrants. What you want to do at this part of the transition market is, I'll call it the Warren Buffett playbook, which basically buy these legacy, once in a generation investments like asset. You're not as focused on price. You say, as long as it's a fair price, not crazy. Like if you can get Google before they go public and Amazon, these are once in a lifetime companies. And that's going to happen, I think, in tech with AI, artificial intelligence, and a lot of the data infrastructure software companies. That's what the private markets are all about. It's different than public markets. You can get access with a touch of a button in the public markets, and the private markets, there's a lot of work there. So the innovation fund and the credit fund are probably the core focus for the first quarter, maybe first 2 quarters, we'll see. And then some opportunistic, very vigilant observation of the equities markets and maybe some distress selling in multifamily. We'll see about that in the coming few months. That's what I think is likely as we go into 2023.
That makes a lot of sense. You mentioned the home builders and spring home buying market. What other leading indicators are you looking at? Because obviously being early is often the same as being wrong. So how do you think about getting the timing on this right as we head into 2023?
Fundamentals. If we can buy a price per square foot or price per unit that is really good at a replacement cost that probably you won't see again in our lifetimes. Unfortunately, inflation just continues to go up. I think my dad used to buy comic books for a nickel.
And I know you're still buying them. How much are they now?
He buys some comic books for my boys. It's about basis. It's about value. Usually when things are really bad, no pro forma tells you should buy it. It's not that easy. So you have to have conviction. So in the right markets, at the right price per square foot, you buy, or the right tech companies. You wish it was formulaic, but it can't be.
So let's say that the Fed keeps hiking rates into 2023. Are you worried at all about the continued drag of that technical impact that we were talking about earlier, where rates continue to go up? And so basically you're discounting by higher and higher numbers. So let's say NOIs are stable, but once again, you're seeing higher discount rates. Is that something that you are concerned about heading into next year?
We assume that the Fed's going to keep hiking rates into the fives. Exactly if that's 5.25 or 5.5 or a little more than that. If they go to 6, then the market is going to have another major repricing. I don't think that's likely. Essentially, the market doesn't think that's likely. Inflation's on the wane. So I think the action is no longer really going to be with the Fed. The Fed shrinks the money supply with quantitative tightening, and they raise interest rates. And then there's this lagging impact on the real economy. So we saw a lot of change in the financial economy in 2022. I think we're going to see a lot of struggles. Some companies will have distress because we have lowly levered rental housing in the Sun Belt. I don't think that's a problem for us. So no, I don't think the Fed's place to look at. That's not the indicator anymore. It's really layoffs, unemployment, business slowdown, corporate IT budgets. That's the pain coming. We have debate inside. Is there going to be a soft landing, or it's going to be a little worse than that? I think the real economy is actually going to do decently well next year. It's going to be a recession, but I don't think we're talking about a hard landing, which would be a great outcome.
Yeah. One other thing to just go back to what you were talking about earlier in terms of the value creation in the portfolio. I think we saw some of this impact in occupancy rates because we were acquiring new communities last year. If that continues next year, is that something that you could see dragging NOI in the near term? Would that have an impact on NAVs in a situation where, once again, we're potentially acquiring communities that aren't fully leased up, or where there might be a lag if there is some sort of a drag in the real economy? Is that something you're concerned about?
I guess I look at it as a glass half full, which is probably blowing your mind. But
is this Ben Miller? Ben Miller 2023, the optimist. New year, new you.
Essentially, if you're buying assets that don't have income and have a lot of value add creation, and there's a lot of opportunity to unlock in those assets, you might not see a pop right out of the gate, but it means that you have one in store for you. That's like, it's a future gift. And if thinking about it more long-term, you say that I'd rather have a big long-term potential than a short, small pop. That's how we operate. We might have a lag because our focus is on value creation. When we move to the next phase, which is the bottom and that recovery, you want to get into equities. You want to actually get into the asset because basically late 2023, maybe early 2024, we could see it come roaring back. If they had an armistice in Ukraine overnight, that would catalyze the entire market and transform basically people's outlook. And what's happening with AI and GPT-3. When I went into 2022, about to be optimistic because I think that the pandemic created a lot of new growth in the country, a lot of innovation, just stirred things up. We paid for it. It was hard and it was brutal. But the silver lining is that there's going to be a lot of dynamism in the United States afterwards. And we just got pinched by, it was a 15-year cycle, time for the economic cycle to restart. And we maybe went too far with some of the stimulus. So yeah, I'm optimistic. When it happens, we don't know, but that's what 2023 is going to be, working our way through this transition period to a whole new, whatever, it's a new year, a rebirth.
Oh man, should we end on an optimistic note? I don't know.
Let's do it, Kendall. Let's do it. It's like you take the pain and you move forward. Yeah, let's be optimists for 23.
I love it. Well, thanks again for having me, Ben. This has been great. I feel excited about the year ahead. I hope you have a great New Year's Eve.
You too, Kendall. Hope you get some sleep.
Well, let's not be too optimistic. We know that's not going to happen.
Realistic optimism. Yes. That's our watchwords.
Oh, man. Well, thank you all for listening. Please feel free to send any questions to contact@fundrise.com. We would love to handle any additional questions you might have or feedback on this episode. Thanks for listening.
Yeah, see you next year.
Thanks again, Ben. Bye.
A quick addendum. We recorded this episode up to the last minute, and so some of the numbers moved slightly with the near final calculations. First, the income fund's latest estimate is it was up 6.1% for the year 2022, and then same-store net operating income growth for all residential in the flagship fund was 14% growth for the year. You've been listening to Onward, the Fundrise podcast. My name is Ben Miller, CEO of Fundrise, and my co-host is Kendall Davis, Head of Investor Relations and Investment Operations. Finally, for more information on Fundrise sponsored investment products, including relevant disclaimers, please check out our show notes. This podcast was produced by The Podcast Consultant. Thanks for listening, and we'll see you next episode.